This is Ash Heatwool, Director of Wealth Management at Graveslight Lenhart. Based on the positive feedback received from many of you, we are opting to communicate via video not only for our quarterly newsletters, but also for our shorter monthly updates in between. The purpose of these short monthly updates between quarter end is to provide insight as to what we've observed in the markets during the prior monthly period, while also pointing out a useful takeaway or trend which we've observed in the form of a chart of the month. We continue to welcome further feedback from our clients. On the right side of the slide is a performance table which provides returns across major asset classes for the month of February, year to date, as well as 12-month returns through the end of February. You'll see that for the month of February, equity returns were strongly positive and broad-based, as markets largely shook off looming concerns over inflation, as well as uncertainty surrounding the future path of rate adjustments by the Federal Reserve. While small cap stocks, as represented by the S&P 600, lagged, we started to observe a broadening in the year-to-date rally as mid-cap stocks outpaced their large-cap brethren. The broad bond market, as measured by the Bloomberg Aggregate Bond Index, experienced a weak month of performance as interest rates moved higher during the month. Hotter than anticipated job growth and inflation results for the month of January were major drivers of interest rate moves during the month, as the bond market translated these key economic releases to price in a delay of future rate cuts by the Federal Reserve and fewer of them for 2024. For reference, the federal funds futures market, which is often seen as a barometer for what's being priced in by the bond markets, had entered the year pricing in as many as 6 rate cuts for the full calendar year. As we exited the month of February, the expectation for 2024 rate cuts has been lowered to 0.75% rate cuts, as recent economic releases suggest the Fed may have to leave its policy rate at a higher level for longer. This is our chart of the month, with the data compiled by Charles Schwab. One of the questions often on clients' minds is, what does it mean for the markets if the Federal Reserve starts to cut rates? We provided a similar illustration during our most recent quarterly update. In this picture, we are also adding some insights into bond market dynamics following the final rate hike over the last 5 cycles. To provide a refresher, the illustration on the left side is for the 90-year period between 1929 and 2019. 3 months after the Fed stopped raising interest rates, the most negative S&P 500 decline was about 35%, while the most positive increase was 12%. For equities, the spectrum of outcomes has historically been incredibly wide and can ultimately depend on the type of rate cut that is being applied. For example, emergency rate cuts, which tend to be dramatic and large scale, are symptomatic of an economy that is rapidly slowing down, which can bode poorly for stocks. That would be an example of a bad rate cut. On the right side of the chart, we see 6-month bond performance as measured by total returns following the final rate hike during the last 5 rate hiking cycles. The dark blue represents bonds carrying a short-term maturity profile of 1 to 3 years, with the lighter blue portion representing intermediate term bonds carrying a higher maturity profile of 5 to 7 years. Historically, once the Federal Reserve has finished raising interest rates, longer maturity fixed income rates have tended to decline, favoring intermediate term bonds relative to short-term bonds. Hence, for bonds carrying a longer maturity or duration profile, they can actually receive a greater price benefit were interest rates to normalize. While history does not always repeat itself, we see the benefit of a higher real interest rate backdrop, which can compensate for a more intermediate maturity profile as being attractive for our clients' portfolios, which include fixed income securities. Thank you for your time and interest. As always, please let us know if you wish to discuss these items or any other issues related to your financial planning needs. We are here to help.